Hey everyone, this is John at Blueprint. Today is March 31st, 2022, and this is the monthly asset allocation update video. In today's video, we're going to go over the asset allocation changes as we head into April, and we produced the video as a supplement to the longer form written piece, which this month there's a lot to talk about, particularly the first quarter performance in U.S. equities. We had a 14% drawdown in the S&P 500, followed by a subsequent rebound of about 11%. And this comes after we hit an all-time high in early January. So it's been a very busy quarter. And this month in the written piece, we really stress having an objective process, being adaptable, as well as coming to terms with the fact that we know that we don't know. No one knows the future. And so trying to predict markets, we believe, and we always reiterate, we feel like is a fool's errand. But particularly in the midst of the noise and what's going on in equities, trying to do that now is particularly dangerous, as your brain may be prone to extrapolating what's happened in the most recent past. And so we discuss that at length in the note, and then really tie it back to our process and how we're going about things and heading into the second quarter and the month of April. So where are we going? Well, first of all, we are increasing U.S. equity exposure. The intermediate term trend has turned positive in U.S. equities, joining the long-term trend. And so we will increase exposure there. International equities will remain at their strategic levels. They're handing off their exposure to U.S. equities, and they maintain downtrends in both the intermediate and long term. Real estate has bounced back as well. In fact, from the lows, real estate has performed better than tech, and tech has made it quite a run from the lows we experienced just a few weeks ago, about 10 trading days ago. So exposure in real estate will increase. The intermediate term trend has re-engaged and joined the long-term trend. And so real estate exposure will increase along with U.S. equities. From a fixed income perspective, fixed income of any duration, really of any significant duration, remains weak. There will be no exposure changes to U.S. or international treasuries, as well as inflation-protected securities. And on our alts, in our alts portfolio, gold will remain constant, as exposure won't change due to the fact that the intermediate or long-term trend hasn't changed. They both remain in a rising trend state. So where will this exposure come from? It'll come from ultra short-term duration bonds. We've been parked there as we've been in downtrends in equities or quasi-equities like real estate. And now that those trends have resumed, we will just simply pull that exposure back on through our handoff process, generating an increase in equity exposure heading into April. So what that looks like here is essentially we're taking the exposure from U.S. Treasuries, as short duration as we can possibly go, and that exposure will hand back off to U.S. equities, and U.S. equities will now be overweight in the portfolio heading into April. So what are the key takeaways? Well, given the rebound that we've seen in U.S. equities, we have a rising trend state now over both time frames in U.S. markets, not international, but certainly in U.S., and that exposure will increase, handing off the exposure that has been sitting in ultra short-term fixed income now for about 2 months, or at least since the end of January. So at the beginning, I talked about knowing that we don't know. And for us, that just means it really all boils down to employing an objective rules-based process. It's natural to ask ourselves as humans, what happens next? And our desire for certainty drives our desire to want to predict or know the future. And from a risk management standpoint, we think that's incredibly dangerous. Not only is it dangerous because your ego gets invested in a prediction, but predictions are inherently unreliable. So for us, it's about putting ourselves in a high probability position of succeeding over the long run. And for us, succeeding is performing well on a risk-adjusted basis and protecting capital in the face of drawdowns. Now, we experienced a drawdown of about 14% in U.S. equities, the S&P 500 that is, in the first quarter. We have not seen new all-time highs, so the drawdown continues. It's below its high water mark, but we have experienced a double-digit rebound from the lows, and where we go from here is unknowable. But what we're going to continue to do is honor our process, maintain discipline, and maintain objectivity. And if U.S. equities are to continue their drawdown and hit lows, then we will just simply honor the trend. The intermediate term trend would turn down from that point, and we would reduce exposure. But now it's the opposite. So we'll increase exposure. We'll continue to manage risk. We'll continue to take advantage of opportunities as they present themselves. And most importantly, we'll do so with a high degree of discipline. So from a client service perspective, what can we do for you? We've done a lot of writing this quarter. We've answered a lot of questions this quarter, particularly around Russia and its impact. And in the face of downside volatility, a lot of questions arise stemming from how we're protecting capital and how we might protect capital even more in the future. So if you're curious about those, if your clients have similar questions, please feel free to reach out to us. You can go to our website, blueprintip.com. You can email me. You see my email and phone number on the screen. Please feel free to reach out to me directly, and we will get you all the data, information you want and answer any questions you have. So with that, the first quarter was unique historically, and we continue to honor our process. So I hope you have a great end to the first quarter and an even better April, and we look forward to seeing you again at the end of April. Thank you.